About infrastructure, the biggest enabler and the biggest risk is common, which is government. Having an idea of near-term or medium-term plans, policy objectives, various missions, that is very important. Crux lies in figuring out fundamentals. When I was working in NTPC, was the period when this sector was going through a transformation. For utilities, just comparing everything on PE may not be the right thing to do.
Hello friends, so welcome to Sadhan podcast episode. I'm really super excited to bring a veteran of power sector. But so far we have discussed data center in quite length, and we all know that data center cannot run without power. So continuing this process of knowledge discovery from data center to going backward to power sector. Happy that our guest has obliged his few hours to us for getting this knowledge put across the retail investor so that investor can understand the nuances of the sector before getting into those stocks which sometimes prove to be risky. This podcast mein we will be looking at what is the breakup of power sector, who are the major component supplier of a power industries, and what are the nuances behind those stock price movements sometimes because underlying businesses changes. And if we try to understand the undercurrent, then we can understand the power sector, and then making money in a way which is sustainable would be a very easy exercise once we understand these stocks and its basic prima facie function. It would be a functional podcast. Deep में जानेंगे. It's not a superficial podcast जहाँ पे आप कुछ नाम शेयर करेंगे. ऐसा कोई एजेंडा नहीं है. This is not a recommendation platform also. So it would be purely knowledge based. And thank you, Abhinav, for allowing us to host you. And look forward to hearing a lot of information, a lot of synthesized knowledge from you so that a retail investor can benefit out of this discussion, which we are going to have in coming 1-2 hours.
Thanks, Amitabh. Always a pleasure speaking with you.
We know each other since last 12, 14 years. From the first meeting itself, I know that you are an NTPC guy and your sectoral knowledge has amazed me since back then. So if I have to think about power sector, then your name comes naturally to me. So you are my first port of call for any key insight into this sector. So I am just sharing my insider for wider audience. Maybe if you would like to talk about how you have moved from an engineer to an MBA and to a corporate banker now. So you are not just a power sector expert as an engineer, but also providing project finance to power sector. So you have already wore two hats. How has been the journey?
I think the journey has been very fulfilling. It was largely planned. I started off as an engineer. I'm an electrical engineer, and I was a very passionate engineer, passionate about my core subject of electrical engineering. And that prompted me to go for a core job in NTPC, where I was working in power plants. I had hardcore ground experience for 3-4 years in some of the largest operating power plants and then in one of the largest under construction projects of the country. What had happened was that my affinity for the sector when I was working in NTPC only increased. This was the period at the beginning of the century, early 2000s. So I quite, enjoyed working in power plants, and maybe I got a greater glimpse of the developmental impact which this sector has, on the economy. And that was the period when this sector was going through a transformation. Mm-hmm. It was largely a public sector dominated industry till that point in time. And sometime in the early part of 2000s, privatization started in this sector. So I was working in NTPC as an engineer.
Right.
And then decided to go for MBA. I went to ISB. And then after completing MBA, so while, typically when somebody goes in B school, he has a choice of going into an IT sector, marketing, and a very conventional, options are there. But for me, I was very clear that I'm not going like a regular B school student, and just joining the bandwagon. For me, my the domain where I was supposed to work after MBA was very clear from the beginning. Okay. So after that, I remained in the same sector, power and infrastructure. Mm-hmm. But from a technical side, I came on, and then I worked with corporates, with the boutique investment bank, All this while on the finance and strategy role, either as a corporate side or as an investment banker, and then I became a project finance lender, where we also work closely, and then that has been continuing. Core area, I think for me that was finalized at the end of my engineering itself.
Okay.
You
So
know,
you have logged in.
nearly 20, 24, 25 years ago that I will be
Oh.
in this sector. So I think it was largely driven out of passion
Mhm.
and kind of affinity for this industry. So I'm happy. Industry has gone through a lot of transformation, a lot of ups and downs. So life has not been boring at all.
Yeah, because of so many changes you have witnessed.
Sometimes there are positive peaks, sometimes there are negative drops, but yes, I always had thrill.
Wonderful. In this podcast, I would like you to just throw some color on the overall structure of power sector, so that a beginner, a person who doesn't have any background of engineering, let's say कि वो कोई बीकॉम करके ही कोई बंदा भी ये पॉडकास्ट सुन रहा है, टेक्निकल पार्ट में you are the superstar. You had worked on NTPC for 7 long years and actually आपने install किया हुआ है plant, so you know what are the operating parameters, what are the operating equipments we use. So first of all, let's take a maybe 30,000 feet view that आपको ऊपर से सेक्टर कैसा दिखता है, if you can classify in your own way, whatever way आपको अच्छा लग रहा है, so that a person can relate to it.
I approach it in a very top-down way. Power industry comprises of three segments, three functions. The one is generation, second is transmission, and third is distribution.
Mhm.
So generation basically, means generation of power using some physical mode of energy. It
Okay.
can be a coal-based power plant, it can be a solar power plant, it can be a wind power plant, or it can be a hydro power plant, or a gas power plant, or a nuclear power plant. There are 7 8 different technologies through which you generate power.
Right.
Now, so power generation typically happens in a concentrated way, wherein at a particular site a power plant is put up,
Mhm.
which are called power plants.
Mhm.
And then this power which gets generated at certain places, then it has to be transmitted to the consumption centers. Now, what are
Mhm.
consumption centers? These are all the cities, the industrial clusters, the small towns, hamlets, where people live, or where there are commercial establishments, industrial or industries which have to consume power. So that bit of transmitting power
Mhm.
from generation point to the consumption point is called transmission.
Mhm.
And when the power reaches at the doorstep of the cluster where consumers are there,
Okay.
from there distributing it to each of the customer,
Mhm.
and billing it and collecting payment of that is called distribution. So these are the three segments power sector. Why power sector is divided in these three segments
Mhm.
is because of the nature of the work which is involved.
Okay. So it's a division of
So if yeah,
division of work
like
actually.
division of work, the nature of competency, the nature of management capability which are required
Mhm.
differs between each of
Okay.
them. In the earlier days, the entire power sector ecosystem, and when it was completely government owned,
Mhm.
there used to be one entity which used to be responsible for the entire value chain of the power, and that we used to call it SEB, State Electricity Board,
Okay.
wherein who
Mhm.
used to own the power plant, who
Power
used to
plant.
own the transmission line, and who used to handle distribution.
Yes.
And then, but the system was very inefficient. There were huge losses, a lot of shortages,
Mhm.
power thefts, under recoveries, and the state was in mess, and we used to have a lot of load shedding, power cuts in the country. Well, that was last century. And then a lot of reforms were initiated, and it was figured out that then in order to improve the productivity and the efficiency in power sector, it's important to have a very focused, efficient management.
Mhm.
And then it was figured out that each of the elements has different, very different characteristics.
Mhm.
So power generation is a very engineering heavy job.
Okay.
There will be a particular site where boiler, turbine, and generator will be put up, and which are to be operated by a bunch of very very qualified engineers. It's a small site which is to be handled by a bunch of quality engineers who
Mhm.
have to operate under a very very strong process culture.
Okay.
Transmission is a different ball game. Transmission is something involves large towers, which we typically, when we step out of any urban area, we see those
Mhm.
large transmission
That's
lattice
ours.
structured type towers which carry power at 400 kilovolt and all. So what it requires is there's a different kind of ball game that you have to put large towers, and which are very stable. They last for 40 years and sometimes even 70 years. So what you need is that you get the tower installed properly, and then once in a while you have to inspect it and ensure that
Running
there's no
smoothly.
major flaw which is kicking in. So that's again a different kind of work. And
Mm-hmm.
distribution is when you reach doorstep, let's say of Ghaziabad.
Mm-hmm.
Now power has come from maybe Singrauli to Ghaziabad through
Mm-hmm.
those tall transmission towers.
Right.
But at that voltage, it cannot be brought to your home. It has to be brought to your home at low voltage. So you will typically have a substation at the periphery of the city from where the power will be stepped down at low voltage level, and then it will be and then the small towers or nowadays underground cables take it to our homes.
Mm-hmm.
Now that is a more dirtier leg of the power sector,
Okay.
because here where the monetization happens.
Mm-hmm.
So the power reaches the doorstep of every customer, and there, the consumption happens. There are meters where billing happens, and then those billing needs to be collected. So this is less engineering
Hmm.
and
More of
more
a
of
people management or
people management, and this particular leg has in the past had huge political interferences,
hmm.
because
Because
it was a very
touchy
easy
topic.
target for exerting, showing your influence, power.
Hmm.
There will be pockets of political strongholds where it may not be possible to collect. They will consume power for years and years but not pay bill, and it will be a prestige issue for them, that yes,
Hmm.
you are not supposed to pay bills. There can be thefts, there can be all kind of mischiefs, corruptions. This is the distribution leg
Yeah.
where monetization happens for the entire value chain.
Somebody who wants to learn how to do investment is what I have learned over last 10 years by reading to Warren Buffett, Charlie Munger and Phil Fishers of the world. And I applied it in India since 2015 to 2024. So 9 years of applications and 5 years of deep learning, as well as 10, 12 years of experience into markets, particularly into financial market. I worked in CC Bank and L&T Infrastructure Finance and Tata Motors. So I have those industrial angle to it. So that helps me deriving something good at a business fundamental level and at financial analyst level. That's I try to impart with in the form of a investment framework, around 25 plus live classes over weekend के थ्रू मैं उसमें बताता हूँ. I share my excels जो कि काम बिल्कुल ही आसान कर देते हैं. आपका 5 मिनट में आपकी एनालिसिस हो जाती है. मोड कैलकुलेटर 2 मिनट में काम करता है. साधन ROIC शिफ्ट फ्रेमवर्क इज ऑल्सो एडवांस टूल which helps you gain की company कहाँ जा रही है directionally. These are the tools which help somebody make wiser decisions. So, and I also share recorded videos and complete access of learning management system. So obviously many things which I keep dabbling into, I keep sharing there, and they also help me in research also. Some more of a assignment based classroom also. So, and I share everything which I learned in the last 10 years so that people can develop their sustainable investment framework. Okay.
In the earlier days, everything was public, was government owned.
CV.
Then privatization was done. Then I think the privatization happens most extensively in generation.
Okay. If you can give us the timeline of when this liberalization happened of overall like
So
power.
liberalization was initiated in 90s
Hmm.
in Narasimha Rao government, and was the most infamous case of Enron, Dabhol Power
Okay.
Project.
Dabhol power project. Yeah. Just to give a background of Dabhol, I mean, correct me if I'm wrong. So Dabhol was the first case where MNC has come into India to invest into power sector. So first time Mr. Narasimha Rao, late Narasimha Rao, who today got the Bharat Ratna also. So he has liberalized the economy and he wanted private sector to participate, and a US based company Enron has participated into it. But if somebody had done CFA, then he knows that there's a well-known scam name attached to Enron, and Enron was not well run, and they have bad corporate governance issue, which was related to auditors and all those things. And for that matter, the company has to wound itself up in US, and that's why our most talked about project of India, the whole project, was sent to the back burner. If you have an update over it.
Dabhol project was constructed. It started operations also. Enron as such had a lot of issues, which
Mhm.
came to the fore later on, when
Right.
the scam unfolded.
Mhm.
And the way Enron did things in India, that was also done in a very bad way.
Okay.
The way all the arrangement was done, and was again not done in a clean. Project had problems,
Mhm.
parent had problems.
Okay.
So it was like, on both sides, there were problems.
Okay.
Project which was there in India, the Dabhol project, that got stalled because of project level problems. So the way project level structuring was done for the contracts. So eventually, I think the long and short of it was that the price of power was supposed to it was obnoxiously high. It was like 20 something around
20 rupees. Oh,
way
okay.
about 10 rupees.
Oh.
Because the planning was of low quality, it was the first private venture in power sector. So even the policymakers were not
Mhm.
very sure how to approach it and all. Plant started, so maybe in less than 1 year of operations,
Okay.
the cash reserves of MSEB, Maharashtra State Electricity Board,
Mhm.
it got completely exhausted.
Oh.
I'm saying I may not be 100% accurate on this,
No,
but I think my sense
yeah,
is
by
largely
and
accurate.
large.
This problem that whatever you have in which this plant has been created, it is non unviable. It can't be operated, and things needs to be
Relooked.
reworked.
Yeah.
Even if it means the contracts have to be reneged, it has to be, that was a larger realization which happened in the entire ecosystem. The plant came to a halt. And by the time that happened, the Enron scam also came to the fore. So
Mhm.
it was like double, triple whammy which happened.
Mhm.
Then the plant, remained mothballed for a very long time. Sometime then the resolution was done wherein seven parties came together,
Okay.
five banks,
Mhm.
uh, five prominent lenders. One of them was ICICI Bank,
Mhm.
SBI, and I think three more banks, and five lenders and two PSUs, which was NTPC and GAIL.
Okay. Oh,
Uh,
the White Knights.
they took over the equity,
Okay.
and the things was that the five banks, they were the lenders, so they converted their debt into equity to something of that sort. NTPC was supposed to handle the operations,
Mhm.
and GAIL was supposed to provide the gas,
Okay.
or
Oh.
naphtha.
Mhm.
That was a scheme under which the resolution was done. So, in fact, when that happened, at that point in time when NTPC took over the operation, I used to work with NTPC only at that point in
Okay.
time. Engineers from a lot of projects were called into, were posted to the whole project
Mhm.
for its revival. Even I had the option of relocating there, but it didn't. It didn't happen. But what I hear from those guys, my friends who actually went and worked there, was that the plant which was created, it was quite a state of the art plant,
Okay.
purely in terms of the
Interesting.
infrastructure which came in there.
Mhm.
Like typically the standards are different in developed world and
Mhm.
in India. When they put up the plant there, they didn't differentiate in that. They put up the plant if the way they would have put up in US. I'm
Oh.
representing here the investor community who follow Sadhan in a way. And Sadhan पे जो investor हैं, they actually are slightly clueless about this sector. Where what we have noticed so far that there is some frenzy in this sector, but there is no specific tool to figure it out to differentiate between an apple and an orange. So we are giving the same how to all kind of vegetables, all kind of fruits, but we need to differentiate ourselves. We need a tool, we need a framework, and that's why we need what like you to pinpoint us that how is it different for, let's say for example, is it on the other extreme like pharma जहाँ पे every company is different and unique, उसका अपना एक market है, उसका अपना एक molecule है. So सारी कंपनियां अलग है. Pharma is a diversified sector. N types of companies could exist in a same sector which is pharma. Is power like that, or it is more like कि तो एक generic sector है जिसमें everybody is doing the same. Everybody is doing the same job. For example, steel. So there could be a qualitative difference between Tata Steel and let's say JSPL की steel की quality में, but the business model wise there is no difference. So steel is more cohesive and pharma is more granular. So where do you put this sector? So it will be closer to steel, wherein you will have a lot of segments, and then within segments, there will be a lot of commonalities. Okay. So for example, in steel, you may also maybe able to create multiple segments. On one side, you will say there are like big steel plants like Tata Steel, JSPL, JSW, and then there will be some contractors, some service providers. There will be some pellet, guys who are into pellet production. There may be some guys who are into ply of coking coal. So all those who are reliant on the steel business cycle. If somebody has a good hang of the business cycle of steel, and he knows how each segment is different, then one may be able to find pockets of opportunity. It could be in a mainstream steel company. It could be somebody who is down the value chain, somebody who is a service provider, somebody who is at the front end, back end, or somebody who is a contractor for them. So then you can find the pockets, and within pockets, obviously there is a similarity. So let's say if there are some EPC contractors who specializes, or there are some equipment supplier who supplies components of steel plant. So all of their fortunes will depend on if new steel plants are coming up, and then there will be little things to differentiate between them. Power is also something like that. In this business cycle, there are various segments which exist in the core electricity business and in the industrial ecosystem, which is dependent on the electricity business. Very fundamental difference. If somebody is looking at the entire market, a typical company typically evaluated on the basis of going concern model. The underlying belief is that if this company has gotten listed, what it means is that it has created some place in its market. Now it will grow and grow. And it will probably have some terminal value, which try to capture by some multiples, because it's a free market. Generally, it's a free market. It's if you are in consumer business, you're in pharma business, cloth business, there's a free market. If you have created a presence, your business, there's created and it will grow. Power business is not inherently a free market business. You cannot just enter into the business of power on your own. Nowadays you can, but the capital outlay and the management expertise and the technical expertise required there is enormous. So because of that, government encourages participation of private industries in their targets. Or in their mission,
Okay.
and those targets, those missions, are the inherent driver of the business prospects in this entire sector.
So you are saying to us that the government is a major entity which is participating
So
in.
if I talk about infrastructure, the biggest enabler and the biggest risk is common, which is government.
So
If government decides, that in country needs more electricity, country needs more roads, or country need more airports or seaports, so you will see huge business volumes there, because it is all to be awarded by government or facilitated by government, either in PPP model or some other model. Also, the biggest risk which in this business lies is the government's policies and regulation. Sometimes if the regulations are become tighter, use that kind of halts the growth rate. Sometimes when it becomes very conducive, it kind of provides an exponential boost. So this is an artificial marketplace which you have in infra business. For entire infra, the power is one component of that. One thing is very clear, that having good understanding of the government's priorities, plans, and these are all in public domain. There's nothing great shakes about it. At a macro level, having an idea of the what are the near term or medium term plans, policy objectives, various missions, regulatory developments which are happening in the sector. That is very important, in order to find, where you may see growth in revenues or profits and all. Crux lies in figuring out which is where is the fundamentals, which is the business performance is likely to improve.
Right.
And so it is very heavily dependent on the policies. Very good thing about this is that 99.9% of it is available in public domain.
Okay. So that's the
You just need to know that okay, these are the portals where you can find I think the level of public disclosure in this sector is fantastic.
Yeah.
But after putting this overarching framework, that is a very government dependent artificial marketplace. Now, if I come on to the electricity business, if I come specifically in the value chain, so there are as I talked earlier as well, there are three main components in power business: generation, transmission, and distribution. Generation involves putting up a power plant, solar, thermal, wind, hydro, and which generate electricity. Transmission involves transmitting it over thousands of kilometers, and distribution is the last mile connectivity where you monetize, where the monetization happens in the value chain. So now, what you have in this value chain, there are two kind of entities. One are called utility, and second are contractors, stroke OEMs, stroke service providers. The utilities are basically the entities which own the asset. It is fundamentally a capex model. In that business, you are supposed to put a large capex upfront, set up some capacity. If it's a generation capacity, then the business model is that your power plant will help you generate certain amount of power, and it will be sold under some agreement.
Right.
And it is the agreements are configured in a way so that you make particular ROE on the investment you have made.
Our audience needs to understand जो आपने बात की fixed ROE की एक return on equity. When you are saying that you are creating two classes, one is utility who is owner of the asset and he wants to get things done by OEMs, by system integrators and by contractors, right? So ये जो utility होती है, they have a public welfare in mind.
Generally, the way it happens is now the business entities work as business entity. Ensuring public welfare is the responsibility of the regulator and the nodal agency.
Okay.
So for example, even if it's let's say it's a private power company, let's say if I take an example of Tata Power or JSW Energy or NTPC, they're all like regular corporates whose objective is to conduct their business and earn profit. Through their business endeavor, the public welfare happens. That is largely taken care by the regulators, with Central Electricity Regulatory Authority and Central Electricity Authority, and the Ministry of Power and Ministry of Renewable Energy above them.
I'll keep simplifying this for my audience. Then there are two animals. One is utility, one is the service provider. And then there is a one layer which monitoring both of them and more closely to the utilities maybe by CERC and Ministry of Electricity.
I think we will need to go back a little bit in history.
Okay.
In the earlier days, power was completely it was entirely in public sector. It was it was a requirement for public good. It is something like municipality. Okay. That every city needs municipality, so every country needs power. So it's government responsibility to provide power. So government was doing everything which is required in power sector, which is in power business. Right from putting up a power plant to transmission line to distribution and even the coal mining, which is required. Even the equipment manufacturing was done by BHEL, which was public. Why private investment came? It started in 90s.
Right.
And obviously started at a slow pace with some stutter but then picked up scale, and then there have been frequent clips and falls, but largely it has progressed. So why? It was simply that the government machinery or the public sector machinery was not able to keep pace with the requirement of the country as far as the power is concerned.
So demand was greater than the supply.
The demand was greater than the supply, and it was felt that the government's the public sector management bandwidth, capability, capital constraints, and the inefficiencies which inherently creep in a non-competitive setup is impeding the growth. And so, if in order for economic growth of the country to prosper, the power growth, consumption, and economic growth are completely intertwined. So so then you need to have more players enter in this, more investment enter in this. Now the first question when you privatize anything is that will it result in the larger public good, or will only result in some people making extraordinary profits? So then a regulatory framework was put in place, wherein an authority was named by the name Central Electricity Regulatory Commission. I think the most pivotal point in this is Electricity Act 2003, wherein the entire framework for the sector was put in place as to who will decide, who will plan for the capacity, who will decide what to award, what will be the rules of the ball game, and so it was done in a way which is results in overall development for the sector. More number of people should come in, but there has to be good competition, because if there's no competition, then typically the guy who is having monopoly or oligopoly, he will take the entire value with himself. There has to be a fair play. So all this framework came in place, and which has subsequently got little tweaked for a period of time. Fulcrum of any PPP business is that what you are awarding on a PPP basis should be standardized to a large extent.
For the better understanding of the topic, Can you explain what PPP is for the audience?
So PPP basically refers to public-private partnership, which is a very prevalent mode for for encouraging private investment in the sectors which are governed by public sector or which are governed by public authorities or government bodies.
PPP and infrastructure and power as such is generally a high durable business versus EPC, which is looks like a more of a short term business. So valuation पे अगर हम बात करें, if we slightly change the gear for a moment, who do you think should command a better premium as a
So,
valuation?
Amitabh, I look at power sector very differently. One thing which I would say, one thing which is very different is this is an artificial business. It's not a going concern which will last for 50 years or 100 years. There is a finite time span in this business. One thing which is also there is this is a business in which you can do DCF. In any other business, your DCF stops after some time, and then you say this is a stable state, and in a stable state, a FMCG company command this multiple, so I will have this multiple. Now, wo multiple, you can make some guess. If this multiple means 3% perennial growth. No. In power, I can value a company without looking at any single comparable.
Correct.
So if you give me a company and I will understand the business model, and then I don't need to know उस company में और कितने sector में कितनी कंपनियों में क्या trade हो रहा है, वो trade हो रही है, everything, even if everything is unlisted, I can find a fair value.
Famous example here is when many investors have gone wrong in case of Noida toll bridge, which was on paper was a free cash flow machine. And if you DCF, you'll find a greater value. I mean, it's a case study in infrastructure investing, but there was a concession agreement which was more favorable towards the developer. And ultimately, the Supreme Court decision came in favor of not in favor of the developer, but more on the utility side, on the government side. So they could not really take benefit of that कि repayment होने के बाद जो free cash flow आ रहा है उसको उन्होंने curtail कर दिया so that it cannot go on a going concern basis. तो उसका DCF अगर हम day one पे करते तो then we would have to change our model when a significant portion has been paid out to the debtors, to the lenders and to other system. जिसको भी पे करना था वो पे आउट के बाद जब फ्री कैश फ्लो कैश काउ पोजीशन में जब वो कंपनी आई वो एक यूटिलिटी ऑफर कर रहे थे. दे आर अ टोल कंपनी, रोड कंपनी, इंफ्रास्ट्रक्चर कंपनी. तो उनसे वो रिटर्न ऑन इक्विटी जो उनका इनफाइनाइट हो जाता बिकॉज उसके बाद उनका कोई खर्चा नहीं था बट फ्री कैश फ्लो था. तो हाई आरओई स्टेज में जब वो कंपनी गई तो वो राइट टू टोल देम वाज टेकन अवे. वो नोएडा टोल वहां से हट गया. एज ए इन्वेस्टर it creates a confusion for, and many famous public investor has faltered in understanding this side. So as you said that in this infrastructure biggest risk is government, so the government decision changed and then the whole model collapsed, whole DCF collapsed.
I would that example, maybe if I take a 30,000 feet view PPP contract in which the project is awarded, I think those become very important. If your contract has ambiguity, that what needs to be done in a particular scenario, so that adds to the risk and these kind of disputes and issues happens. But if the contracts under which the project is awarded, if they are very watertight and all the potential scenarios are covered in that and the authority is known to honor it in letter and spirit, so that is something as an investor, I would say, if I have to approach, if I, again take the perspective of an investor, let's say if I'm investing personal capacity, what I would look at is, does this contract under which this particular toll road or anything else has been awarded, is it a very watertight, comprehensive contract? It happens when there is a scenario which emerges, which is not addressed in the contract.
Right.
And then you have to get down to figuring out, what was the intent, and that's when the things spiral down. Generally, if I would say, if let's say one has to invest, you have to invest, you have to kind of have a sense as to how robust or comprehensive the contract which has been awarded to a particular company, like a certain authority or certain contracts are more robust, and these frameworks are also very widely available in public domain. But generally, I think sticking to the robust contracts is a advisable thing, because there the hiccups or the shocks are lesser. You will only have incremental plus minuses. So that is what I think is would be the takeaway of that case study which you mentioned. How does the power business happens? So let's say state decides, the government authority regulator decides that I need certain generation capacity where I need private capital, I need certain transmission capacity where I need private capital. They could be sporadically on a distribution side. So what they do is it is awarded on the PPP model. When some entity becomes an asset owner, whether it's a generation or distribution or transmission, by design, it is supposed to be a low risk business model, wherein the model is that while you have to put a lot of capital upfront, but under some contractual framework, you are assured of revenues for a longish period, generally 25 years in power sector. The business model of such contracts is configured on the underlying hypothesis that that you have to make somebody invest capital, but then he will make revenues over a long term, and eventually he will end up making a decent IRR, little better than what he could have made, some other investment revenue. That is what so since you have to give him an IRR over 25 years, that IRR will only come when the revenues are stable. So I'm thinking as an approach, utilities are supposed to be the low risk investments. That's why, most of the times you will see large sovereign funds, large pension funds, global sovereign funds being major investors in companies, who are putting up utility projects across the world.
Okay, so you are saying this is a low risk environment for a utility investing in utility.
When you are when you are becoming an asset owner under some PPP model, this is, I would say, the base case intent. Again, now that doesn't mean that every company has same fortune. Within that bifurcation happens, and some shit also happens, which both of us have witnessed a lot. But I think as a theory, as a hypothesis, this is how the business works. So in fact, since we are not discussing a specific company or a specific transaction, we are talking at a sectoral level, segment level, a utility could rather be better measured by price to book than price to earning, because capital is the capex which has been done. That is what is assuring your revenue and EBITDA for a longish term. So the profit will keep on changing, every year. There may be in the initial year, it may also happen, let's say if there is some established company like ntpc who has lots of capacity, so it will always have good revenue and profit every year. But there may be some new entity, it may have a lot of under construction portfolio in the beginning, so there may not be much profit, but the PE may look high. The moot point which I'm trying to highlight is that for utilities, just comparing everything on PE may not be the right thing to do. Maybe if some utilities are exactly similar, in the sense that both of them have been operating for 20 years, and whatever is the capital, the fixed asset which they have, like they have very high amount of fixed assets which are operational, and whatever is under construction is a minor component. In that way, if that is the case, if everything is same between them, it may make sense to compare PE. But what may happen is that if you just look at PE, it may happen that somebody may may look to have high PE because it is right now putting a lot of capital, so that your fixed asset block is coming up, but it is yet to generate revenue, and in the initial years the profit is low.
Interesting.
Because in the initial year you serve high interest, you have depreciation as well, right? So your PAT will be low. However, what is that if somebody has put up 1,000 megawatts at a cost of 8,000 crore, and he has taken the contract while bidding for the contract, he has not gone irrational, and it's a balanced contract which he has taken, which takes care of this. That he is very likely to make an IRR of maybe 15%, 20%, between something of that range in a 25-year time period. Now, within that time period, the PAT will be different across all years. So I think that knowledge is important, that understanding is important, that this is a different sector. So what you need to probably look for is price to book for utilities, and then when you compare 4 utilities, 5 utilities, then you can then get down into the granular aspects, that while each of them have put in 10,000 crore of capital in their respective businesses, but are the contracts for all of them equally remunerative? Which is something, then you get down into the analysis of their annual report and their con call and their investor presentations, wherein it may happen that somebody has taken a large project at better terms, which may probably give him little more IRR than what you expect from an average company. That company will eventually end up commanding higher price to book. Somebody who has probably in desperation gone a little aggressive and taken up things at little thin margin, so their IRR would eventually be lower, and then for the same capex he will then get lower price to book. So that would be the kind of differentiation which can be made when one gets into the specific analysis.
Okay. And just to summarize what you just said, that this utility, which are generally for listed space, most of the utilities are generation companies. So generally saying like company like ntpc, Tata Power, or let's say Power Grid, which is coming from transmission, but is a utility. And discoms, which are not listed per se, but for example, CESC is a distribution company. So for them, price to book is a better metrics to value because the capital creation is the main.
They are very similar to bank, I would say.
Okay, that's right. Yeah, very logically put.
Business model wise, they are similar. Not exactly. There are some ethos which are common.
It's a very interesting point. In banks, we look at the first ratio for valuation is price to book, and you are saying utilities are likewise. So, what similarities are there between these two business models?
Fundamentally, in both of them is same, that you have to put a capital and make the capital work. Starting point is bring in huge capital, put that in business, make it. In bank, you make it run in the market. In utility, you use it to put some capacity on ground, and that capacity then keeps on giving you certain constant revenue over the next few years, which eventually pays back your investment and gives you some return.
Okay.
So in that way, that's a similarity. So in the business model, even though in bank we use it to give loan, and here you use it to put some hard asset, but financially you arrange large amount of money, you then deploy that money somewhere and then recover it back by making some IRR.
Except illiquidity, both the segments are parallel. Like banks are similar to a utility, except that you can anyway withdraw money from banks and they have to keep liquid assets. But in power sector, Gencos, they have to have a long-term assets, which will generate cash flow over a long period of time. Just to drawing a parallel from a valuation perspective, that's in a bank, and since you worked in a bank, you very well know much better than me that a price to book of a good bank is determinant on the asset they have and the liquidity, as well as some softer factor if they have a good technology and all. That's why price to book will go up from 1 for an efficient player. 1 is the benchmark for an average player. And it will go 2 if you have a very good infrastructure, very good branch location, very good network, very softer things. But what are the benchmark for a power company in that regard? Similarly, what are the parallel you draw for price to book?
So I think it will largely be on the two or three main factors. One is on the nature of the project they have taken. What is exactly the contractual arrangement? What is the tariff at which they are taken? Have they been taken at a good tariff, which provides a decent return on the capital invested? Because what you eventually get is, except some of the PSUs which have older contract where you get a cost plus tariff. So the ROE is kind of awarded to you by the regulator, but nowadays you have to bid for the tariff which you charge the customer or the buyer who takes power from you. Now, and you put tariff in such a way that you will eventually end up recovering your investment. So there, one can go wrong and may end up taking project at a tariff which is not viable or which is not remunerative.
अपने पैर पे कुल्हाड़ी मारने वाले projects.
Winners curse जिसको बोलते हैं.
Winners curse, yeah.
Let's say we talked about similarity between a financial services or a lending bank and the utility. So if let's say not all banks will have same price to book multiple. So what differentiates is the quality of the book. The book is of high quality, well, there can be potential losses in the book, but it's your NIMs, your pricing, how remunerative your book is, whether your pricing which you are charging is good, whether the credit costs are under control. And then comes the growth prospect, which is juxtaposed with the management quality. So basically, it's the quality of the book and the management quality which determines which differentiates the multiples between various organizations. The same way in utility, it will be the quality of the assets right now and the management quality which impacts your growth. That differentiates between various companies. Not everybody will have the same multiple because of this reason. Companies may end up in making the same investment, but it may happen that somebody has been able to bid out better, and got a little better tariff at which he is selling his output. That asset is likely to generate more ROE, so then it will reflect in the valuation once it is realized. Or corollary, as an investor, if you can ascertain it, then that's an investment you can make. If you have to pick up that, okay, probably this guy will make higher ROE because his tariff is higher. That's a differentiating between the asset. The other differentiation can also come in the type of contract. So, for example, like you talked about Noida toll bridge incidents, right? So that was the issue in the quality of contract. The contracts, overall were not of high quality. There were things which were unaddressed, or there were loopholes, etc. So which could potentially result in issues. It is akin to credit loss. That you have in a bank. You might have some bad borrowers. It is something like that. That if in your contracts there are some loopholes. So like in industry, that maybe the contracts with central authorities are high quality. They are more robust, more comprehensive. They are honored more. And with different states have different track records. So that is something which differentiates between various utilities based on where they are putting up their capacity, who is basically the counterparty. The second is the management quality, which is again everywhere. For example, if because your job is to select the right project, to construct the right project in the time and cost, in the budgeted time and cost, and then operate it within the budgeted O&M cost, and then make your ROE. So the management who demonstrates, that they have been able to plan and manage their projects meticulously, they command a premium. The managements who have track record of slippages will be awarded, a handicap in the valuation generally. Also, I think eventually when a company is valued, it is valued based on the current book or the current asset block, and also the future prospects, future growth prospects. Now, future growth prospect, I think, is extremely heavily linked to the quality of management. If the management is supposed to have progressive, innovative, right risk management practices, if that's what is teamed out, so the market applies a premium on that. When we talk about fair valuation, and vice versa, when you are not on track, then you are applied a discount. Then a discount gets applied. So that way, utility businesses are typically valued. There are times, because valuations are not static, the valuation will swing over a wide range. So I don't know what's the perfect answer for that, but maybe if I have to do, I as an individual is a safe investor. I'm a very safe investor. I follow deep value investing methodology. So I will probably pick up the one where I see that the current valuation is even based on the current capacity, asset block. The valuation today doesn't look whether it's justifiable on DCF perspective, or it looks very justifiable on that. So basically, what it means is that you are not dependent on the growth component. Basically, I will not have a situation where I'll say I will always invest in this company. I can invest in all the companies as long as I don't see a survival risk in them. That if some company has too much leverage, and because of that leverage it can get into bankruptcy kind of situation, so that is something we will say, okay, this company is to be, can be an existential crisis. Obviously those are the avenues to be avoided, but apart from it, every company can be bought at a certain price. You may say right now the multiples are very high and doesn't look, there is some massive correction in 6 months time, and you say, because in this business, as you talked about at the very first point you made in the beginning of this our conversation, that whether it's a pharma or it's a high tech like Google, where there is some very strong lever, some incumbent develops, and then he just keeps on, or whether it is closer to a semi commoditized thing. So it is closer to the semi commoditized thing, and the nature of the business is like that. It is supposed to be government, keeps it like that. All the industry is configured like that. It should always be competitive. So what I see is, if I approach, I may say this company today. Obviously, I will not even get down to put pen into paper. I will just say this is the asset block, this is the key financial parameter, this is the valuation. Forget about Excel sheet. I may not even pick up a pen, for the estimate. I will give it a pass. But after 2 years, I may put a heavy amount in the company just because the correction has happened, and now the same company, if I do a pure DCF, I say, oh wow, at this price. In fact, when I approach utilities, I don't even look at multiple. I look at like if this is an unlisted company and if I put money in this, if I remain invested for 25 years for the life of the company, will I make an bare minimum IRR?
Okay.
That's how I look at it. If the answer is yes, it's not like if it is not justified, you just say no. But all it means is that if let's say you think you need an IRR of 10%, and based on the current valuation and the prospects you see in the business, you are seeing that the IRR may be 2% in your back of the envelope working. Then you see, okay, I am dependent on future growth for so much delta. I am expecting to come from some capacity which may come in future. And then you may take a call that the management is progressive, they are adopting tech fast, so they will have a head start, etc. You can take that call. There may be some situation where you may think, boss, at this valuation and the current capacity, your IRR will be like minus 50%. At this valuation, for this company to make a business growth of 300% in 5 years is critical for even you to make a 10% IRR. And I'm not thinking about making IRR trading. I'm always think about making IRR through fundamental DCF. Then what it means is that in this case, future growth is super critical for it to this valuation to fundamentally remain in that zone. Right now, the momentum may be in its favor, and market is whether rationally it may be applying a lot of growth. So, but that's what somebody who's into deep value investing may adopt. I understand in market people follow all kinds of approach, but I think understanding it, the dynamics of the sector helps you. And one good thing is that for understanding these issues, you don't need to really be very micro. Mostly based on the publicly available info and the companies or transcripts, I think all this macro perspective comes quite easily. Now, this is on the utility side. I think the more interesting sphere is the allied industry, not the asset owner, but the people who feed into asset owners. So if somebody has to put up a power plant, then he will buy transformer and motors and generators and boilers and solar modules and cables and he will deploy some EPC company to do the construction and and there's a plethora of ecosystem around that, and in which there will be a lot of small caps, minimum type of. I think that universe is way much more I would say dynamic, and also presents opportunity and risk as well. And in that case, and where a PE multiple may be more relevant, PE multiple of 80 may also not be bad. That situation may also happen. So that I think that's a setup. Common thread across all of them is if somebody is a transformer manufacturer or a cable manufacturer or some OEM basically in this sector, figure out whether the multiple is the valuation is right, wrong, or just fair and aggressive, etc. That again is relatively, I would say, easier in this sector once you know where to look for your information. Because if somebody is in this business, he will be that he is not something haldi or toothpaste which he has to sell to all the households by out marketing HLL or Unilever, right? Eventually, power is a government-driven business, so some capacity has to come up somewhere, and that's where his product will go. So, if somebody is in a particular niche, and in that niche there is a massive program, here you will typically not have an incumbent who is like a Google or who is like Nvidia, something like Intel, wherein they have some monopoly. You just cannot replicate it. It's not like that. Here you make opportunistic gains. That you were languishing in some business for decades or for years. You were just going through, and suddenly when some policy, some program got launched, and at that point in time you were the only man standing there. Or maybe you were 2-3 men standing there. So by the time it's not that what you are doing is something which can't be done. In high voltage equipments, it is when somebody has to put EHV transformers or motors or generators, which is a ballgame of Siemens, Hitachi, Mitsubishi, General Electric, some Chinese companies like Dongfeng and all. That is, ABB, Alstom. That's one high voltage. That is one that has a technical, I would say, modes. But on the regular equipment side, it's not that others can't. But what happens is sometimes there may be some transient or something which comes up, and then suddenly that particular segment has either just by luck that you are there, or maybe some people, some entities are more, again, the management is more proactive in sensing things. For example, if smart meters has been rolled out at a very large volume. Now the talk, the plans were there for years, last few years. There have been some entities who are more proactive in focusing on that and being ready when the opportunity comes. So they will reap the benefits. For the service providers, I kind of try to take a sense of how much business they make in foreseeable future, 5 years, 7 years, because this business will again come from some of these programs. For example, if let's say solar pumps, are to be put up, which is coming under the PM Kusum Yojana.
Correct.
So that solar pump, somebody into that pump is not business that it's not a soap or a toothpaste. That once you start doing it, you will continue to do it till the time some maverick comes and block you. You know that this is a finite opportunity. Both kind of assessment happens. It may happen that right now the multiple of some company may look high, but what you may realize is that the multiple high because that guy has low business volume, and at a low volume the profit was low, but that he has already got a big order book, or which will result into revenues in future years, and he is likely to get more orders also. So that his future profits will be substantially several times higher than what it was last year. And then you can say, okay, I know that whatever the valuation it is commanding, maybe that kind of profit cumulatively he will make in maybe 5-7 years, given the order inflow which is expected, and he will grab significant share of that orders if there are not many players already in the sector. And you may find, okay, this valuation is not bad, purely with that knowledge that he is likely to deploy lakhs of meters, or whatever the some scheme or program is giving him volumes. Vice versa, there may be a situation wherein you may find that whatever the program which is driving the business volume for a particular company, even if that company is expected to get a very significant share of those business volumes, it will not make the amount of profit which is commensurate or closer to the valuation, the market cap which it has achieved. So then you may classify that as an overvalued stock, because then it is predicated on that he finding some other business lines as well. That now that capital, he will earn capital, so then he will find some more lines, he will invest somewhere. So which again, based on the risk appetite of a particular investor, he can take a call. If somebody is like somebody super conservative like me, will say, why should I take the risk of that guy finding something 2 years down the line? Somebody will say that, okay, the euphoria will continue, so in 6 months time, the euphoria will only going to increase because more announcements will come and market will apply. So again, horses, different people will have different outcomes based on how they think about the market. But yes, if you have commonality about the underlying business performance, you will probably be better off whichever bucket you are in as an investor.